Hello everyone. Hello everyone. Good afternoon. Myself, CA Rohit Junjunwala, the moderator for the session today. It is my great pleasure to welcome you all to this insightful webinar on controversies in TDS and TCS, organized by the Direct Tax Committee of the Institute of Chartered Accountants of India. As we navigate the complexities of the Indian tax system, TDS and TCS remain pivotal areas that demand our keen attention and understanding. Over the years, these mechanisms have evolved significantly, bringing with them a host of challenges and controversies that professionals in our field must adapt manage. Today, we are privileged to have an expert who will delve into these issues and share his experience and provide us with valuable insight. His extensive knowledge and practical expertise will undoubtedly enrich our understanding and help us tackle the challenges associated with TDS and TCS. Additionally, I would like to acknowledge the efforts of the Direct Tax Committee and everyone involved in organizing this webinar. Before we commence, I would like to introduce the chairman of DTC, CAPU Shajatji. He is a chartered accountant practicing for the last 20 years. He specializes in direct and indirect tax appellate proceedings and arbitration proceedings. He is a speaker on various topics of direct tax, a member of external committee of Reserve Bank of India's Asset Reconstruction Committee, a vital contributor to WRC publication on Vivad Se Vishwas scheme, and he is also practicing litigation in direct as well as indirect tax. So I hand over to CA Piyush Shajatji, sir.
Very good afternoon. Thank you very much, Rohitji. I first of all, my warm welcome to all the participants over here. And I'm very much thankful on behalf of Direct Tax Committee. I thank Mahendra Sanghviji for accepting our invitation and delivering this lecture in month of July, especially when we all know everybody is busy with their tax season. I also thank Rohit Junjunwala for accepting our invitation and being over here moderating this session. Thank you very much for being over here. We all know it's a month of July. All the participants would be busy. So, very shortly before we go to the learned speaker who would be covering all the controversies, and for the information of Mahendraji, we have this time also requested all the chartered accountants and all the team members of ICI to join this seminar because a lot of queries keeps on coming on TDS and TCS, even in our Institute of Chartered Accountants of India. And we have asked them to be joining and they will be also joining. So at least they will be also be aware what are the issues that are involved in the various provisions of TDS and when they are discharging their responsibility and making payments for the Institute of Chartered Accountants of India. Quite often they keep on calling us, keep on calling the experts for taking opinion on that. For the benefit of the members, as I know, there was a lot of issues which were happening as far as portal of income tax department is concerned. Just to brief you what has happened in last 20 days, I thought I'll just take your 3 minutes before we go to the speaker to it. I know there was issues as far as filing of income tax return was concerned, downloading of 26AS, AIR and TIS was concerned. So we had made institute under its direct tax committee made a representation on 5th of July. The first representation was already made to the policy wing itself and also to the DGIT systems also. And thereafter, we made a reminder representation on 12th. We also spoke to them. We were made aware that they are working on that. And they had assured that everything should be fine from 15th or 16th latest, that is Monday, the last Monday which has gone, and the site should work properly. I believe the site is working properly. I am not getting any more messages as far as working of the site is concerned. And I'm happy, though it took long. And this problem of the site was not only in the month of July, I know it started from the last week of the June and it persisted till 15th of July. So a lot of members would have already suffered because of that. A lot of time would have gone. You would be facing an issues with a very short period of time, which is now left for filing the tax returns. But obviously, I think so. They had an issue when we spoke to the TPL wing also. There was an issue with the system, and they were also following up with the system service provider, that is a software service provider. And ultimately, they were able to resolve that, and I believe it is now functioning well. If anything is there, please do write to us. We'll try to take it up. DTC is trying to take up these issues on daily basis. Another issue which I know members are now fighting is with regard to rebate under Section 87 capital A, wherein the utility has suddenly changed after 5th of July. The 87A, which was rebate was being calculated, was available for the short-term capital gain and certain category of long-term capital gains, was available up till 5th of July, and suddenly it has not now been available. Different views are there. somebody says, obviously, our view across the fraternity is that debate should be available for the short-term capital gain also. The representation has been already made by the Direct Tax Committee on 16th of July. We are trying to meet the officials tomorrow in Delhi and try to convince them that this is how the interpretation has to be done. But for your information, yesterday evening I spoke to TPL Wing, in fact, Joint Secretary also, and he had a different view about it. He said, no, whatever was been done earlier was not. Now what has been done is correct. That's what he said in short on the telephone. So I asked him that I would like to meet you personally and explain you and how, if I read 87A, if I read 115 PSC special rate provision. If I read concurrently both, then obviously rebate has to be made available technically. But he was of a different view, and he was of the view what has been done now is correct. But anyways, we'll try our luck tomorrow once again, and whatever comes up, I'm sure we'll try to update all the members also. Meanwhile, a lot of messages have been received by the direct tax committee that what we should do, whether we should file return because there is no calculation happening, or we should wait if some changes are going to happen. So it's very difficult to say today. But tomorrow, obviously, will be trying to speak to them, and I will also try to personally with them. If something comes up, I'll generally update to you. But I've already they've sounded that their interpretation is this only, that there won't be rebate available as far as short-term capital gain is, because that is coming from the words of the TPL Joint Secretary. So obviously, even the systems people cannot act or cannot make changes in the utility unless and until message goes from TPL as far as calculation and implementation of the section is concerned. So I have a less hope on it. But let us wait for another day. That's only I can suggest to the members at this particular stage. And I've been also told by a lot of members that software has now given a facility which is not in conformity with the utility, because utility does not allow the rebate to be calculated. But the software says that whether if you don't want to go with an utility, you can put your own rebate calculation and go and file the return. Probably there may be a defective notice or there may be an adjustment under 143.1. And if that comes up, then obviously the matter of litigation will be open to you. So let's take an example. If you're claiming 87A, if you're able to do it, even if your utility does not permits it, and through some software you are able to do it, and if you receive a defective notice or you receive an adjustment in 143.1, you can dispute it legally also, if you are of the firm view, any of the member is of the firm view that otherwise this rebate should be made available. So those representations which have been sent, I will also try to update you what the representation was done. I've already told my office also that those copies of representation should be circulated amongst the members so they are aware of it. That's what can be done at this particular stage. I do understand the concerns of the members, which generally feel for the assessees as such, that there has also been certain discrimination which is happening, because if you have filed the return before 5th of July, you were able to claim a rebate. That's more worrisome. In fact, we mentioned this to CBDT also, that if you feel what was been done earlier was not correct and now what has been done after 5th of July is correct, you should have continued for this cycle at least. And appropriate clarification or the amendment in law could have been thought of during this budget exercise, which is just around the corner next week. But as it is where we stand today, so I thought I'll just update you on all this. I take this opportunity to update you. Apart from this, as you know, the budget is coming on 23rd. So we'll have a first cut on 23rd evening between 5:30 to 7:30. So members are requested, the discussion will happen between the president, vice president, chairman, direct tax committee. Girish Ahuja sir would be joining, and it would be relayed online. It would be through a webinar on 23rd. And on 24th, we are doing a program in Delhi. But again, Girish Ahuja sir will give a detailed analysis of the budget. It would be a physical program and also live telecasted. One program will also happen in the city of Mumbai on 26, along with WIS, wherein every year speaker Gautam Bhai Doshi would be joining. So this time we are having a joint program, that is a central committee and WIS is doing jointly. So it would be held physically at Yogi Sabhagೃಹ, and that would be also live telecasted. Just for your information, So, of course, from your busy time, this time it's a difficult time. You also have to file the returns, also actually understand the budget, update your clients about it. But I'm sure as a chartered accountant, you are always expert as a multitasker and you will do well. So, thank you very much once again for all of you to join over here. My special thanks to Mahendra Bhai Sanghvi and Rohit Junjunwala to take out the busy time for my members out of your busy schedule. I know because July is very difficult for any person. Both of you are practicing in taxation, but obviously because when it comes to a member of institute, they are always available. Thank you very much for being over here. Thank you. Over to you, Rohit bhai.
Thank you for your kind words, sir. Thank you so much. Now, I would like to introduce the speaker for the day, CA Mahendra Sanghvi. CA Mahendra Sanghvi is one of the founding and senior partner at Sanghvi and Sanghvi. His professional experience spans over 35 years and his areas of expertise are income tax, litigation, and audit. He is past president of the Chamber of Tax Consultants. He is currently advisor of Direct Tax Committee to Law and Representation Committee and member of editorial board of the Chamber of Tax Consultants. He was past chairman of Law and Representation Committee of Chamber of Tax Consultants. He was nominated as member of Regional Direct Tax Advisory Committee by CBDT. He was a co-opted member of Direct Tax Committee of WRC of the Institute of Chartered Accountants of India and member of the Direct Tax Committee of Indian Merchant Chamber. He has written articles for newspapers and magazines of professional interest. He has been regularly representing before Ministry of Finance for pre-budget recommendations on direct tax matters for Chamber of Tax Consultants. These are a few of the highlights of CA Sir, Mahendra Sir's era. So I would like to now hand over the baton to Sir. So thank you so much.
Okay. Good evening, everybody, and many thanks first to Mr. Rohit, and also special thanks to I would say Piyush Bhai for giving me an opportunity, more so to learn the subject of these controversies. And once we start learning the subject, we realize that there are too many of controversies still going on, and I understand that many of the members are still is required, and that's the reason why you have been overshot by the controversies or the queries that you receive on day-to-day basis. Also, again, I would thank Piyush Bhai. As such, though we are very known to each other as a close friends, rather his father and my father were also very close friend, and we continue with this. I'm aware that institute as such has been doing great activities as far as making representations and getting clarifications from the regulators what you people are working on. And I'm sure certain updates what you have given more pertaining to the day-to-day requirement as far as the site problem, a portal problem, I would say, of the income tax and about 87A controversies. Well, I was not aware. Of course, my office did say that there are certain controversies which is going on, but good because of this lecture, I am getting updated about this controversy also which is going on. And it's a little surprising that in between when they want to change the I would say the law for their interpretation purpose is not what should have been done. It's uncalled for. As regards the presentation, friends, my subject would be on the controversies of the TDS. There are not one or three or four controversies, but if you sit and write, it may be running into at times a full day would be a short, but definitely I have taken liberty of selecting certain issues, which in my perception are of day-to-day importance, and looking at the importance from both the sides, more particularly whether it is the deductee or the deductor, because the initial problem arises for the deductor that whether he's supposed to deduct, if he's supposed to deduct, at what rate he's supposed to deduct or to collect. Same way, thereafter, the problem arises of the deductee, that whether he's supposed to offer that income, which year's income, how much to claim, if the income runs into more than 1 year, and all those issues also I will try to cover. I would just start making my presentation along with the talk. And Mr. Rohit, as discussed, I think you will be taking care of the questions what would be there. So
Yes.
in the end, 15-20 minutes, we will just start with that question answer session, so that if there are anything queries, then I will try to take it up.
Yes.
Right. So we start with our presentation, and well, the question comes up: why the controversies when the law is so old? Though the law being so old, still the controversies are there today also. So, what is the reasons for this controversy? Well, it's there are two aspects. One is the law aspect. As far as the law is concerned, the complications are persisting, and I would say that it gets solved. The new complications and the new enactments are made, which gives more of the complications. And the second one is the practice part. So even the law talks about, along with the law, even while practicing, we see that there are certain problems which the law would say something A, whereas when you start implementing, whether it's a procedural part or whether it is in the practice, you find that it is not possible to implement it, though the law would say something. So there's a complications on both the fronts. When we have seen that the circulars are issued, which are definitely, when issued, they are said that it is for the simplification purpose, but at times we have seen that while simplifying, they make it more complex, and more so when we refer to the circulars issued in context to 194Q and 206C1H. There are many issues which are directly in conflict with what the law is. Okay. Now, when we my the topic for today, what is there? The coverage would be a small background and a history about this sections, what we will be taking up, and the developments on those particular issues and consequences of default in complying with those TDS provisions, what we are going to face. I am tempted to take the very small, a very interesting section 4, which is the charge of income tax. I'm sure everybody would wonder that why this right now today, when this is a very old section already there on the statute. But it has its own relevance when I'm taking up this, I would say, section. Now, the relevance is more so provided in the proviso 2, which reads, in respect of income chargeable under subsection 4, the tax shall be deducted at source and paid in advance, and where it is so deducted, payable under any provisions of this act. Here, friends, if you see, the whole issue is important is that the tax is supposed to be deducted, or even the advance tax is supposed to be paid only and only if there is an income chargeable. The importance is of the income chargeable under subsection 1, which subsection is there just on the screen, you can see, which says, and this is the charging section. So if the income is chargeable, then the tax shall be deducted at the source or paid in advance, where it is so deductible or payable under any provisions of this act. So I wanted to highlight this, that the income chargeable, of course, the relevance of this, when we just go ahead, we will realize why I was trying to bring this to the notice of the to all the delegates over here. The another section is section 190, which is deduction at source and advance payment. Here, subsection 1, which reads as notwithstanding that the regular assessment in respect of any income is to be made in a later assessment year, the tax on such income shall be payable by deduction or collection at source. So it says that notwithstanding the regular assessment, the tax on such income shall be payable. And subsection 2 reads, nothing in this section shall prejudice the charge of tax on such income under the provisions. So it is subsection 4 which is ruling the entire section 190 and the provisions related to the TDS. That is very important for us to understand. Going further, as far as the basis of charge is concerned, though I have been saying that the income chargeable or collectible only when the income is chargeable, only the tax can be collected or deducted from that. However, when Section 206 was inserted by Finance Act 1988, that is with effect from 1st June 1988, the provisions of TCS when introduced were as the reasons given was considerable difficulty has been felt in the past in making assessment of income in the case of persons who take contracts from sale of liquor, scrap, forest products, etc. So when this was introduced, the provision was challenged because whether there is income or not, to understand whether this is a provision which is ultra virus. However, the Supreme Court, in the case of Sannyasi Rao, reported in 219 ITR 330, expressed that after all the statutory provisions obliging to pay advance tax is not anything new, and the impugned provisions are akin to that. So we understand that when this provision 206 was held to be constitutionally valid, the reason given was that it is akin to the advance tax. Now, since it is akin to advance tax, we very well understand that it means there has to be an income and thereafter only the taxation should be levied. Now, with this short background, it is clear that the provisions of TDS and TCS are applicable only if some income is embedded in the transaction. Let us further have a clarity to this by certain landmark decisions. First of all, let me take GE India Technology Private Limited, which is reported in 193 Taxman 237, wherein it was held that if payment does not contain any element of income or sum is not chargeable to income tax, then payer cannot be made liable to deduct tax or tax at source. Here, friends, the facts of the case were that it was a software distributor. SSC was a software distributor and it imported pre-packaged shrink wrap standardized software from Microsoft. It was held that there is no deemed income accruing or arising in India. And there the applicability of provisions of Section 195 was chargeable or not. That was the case before the Supreme Court. Here, their Supreme Court held that if there is no element of income, it cannot be charged. And it clearly mentioned that the Section 195 had to be read in conformity with the charging provisions, that is Section 4, 5, and 9. Therefore, the obligation to deduct tax arises only when there is a sum chargeable to tax under the Act. That brings me to the next Supreme Court landmark decision of Transmission Corporation, which is reported in 105 Taxman 742. And there also it was upheld the requirement of deducting tax at source for payment if there is only some element of income. I will not get into the facts and all that because my trust is to bring to your notice what the tax will be only if there is some income chargeable to tax. Similarly, thereafter we had Guwahati Tribunal. However, to our surprises, then we have one section 194N, which is an exception to the above, which is TDS on cash withdrawals, wherein there cannot be any element of income in hands of the deductee. To make section effective, accordingly, the second proviso is added to section 198. The sum deducted in accordance with the provisions of section 194N for the purpose of computing the income of assessee shall not be deemed to be the income received. We will touch upon section 198 also when we just go ahead. When this section was introduced, the question of there is no element of income, whether still there can be any section under TDS provisions. There the Madras High Court upheld the constitutional validity of section 194 and it said that yes, it is constitutionally valid. However, with due respect to the High Court, I still hold a different view whether tax needs to be deducted after considering section 4 and 5 of the Act, as we just read earlier for the two decisions which was there before us of the two Supreme Court decisions. Now, with this background, let us understand the controversy. After taking this, let us go through the controversy. The controversy has arisen between section 198, section 199, and read with Rule 37BA. What does section 198 says? All sums deducted in accordance with the foregoing provisions of the Act shall, for the purpose of computing the income to be an income received. So the section says that whatever the sum has been deducted, that sum is the income of an assessee, that is income of the payee, and it is deemed to have been income received. However, in section 198, I just mentioned 2 slides back, there a proviso has been inserted as an exception by making exception given to section 194N. And this 194N, I am sure everybody is aware, it is regarding the cash withdrawal. When you withdraw from the bank account, the bank deducts TDS on that. It is your own money, maybe a tax paid money. When you're withdrawing from your bank, still you need to take the burden of the TDS. Tax deducted under Chapter 17 is deemed to be income of deductee. Tax is payable on gross income before tax deduction, and credit is available for tax deducted as per the provisions of Section 199. However, the following TDS or taxes are not covered under Section 198. And which are those ones? Tax paid by employer under section 192 1A, that is on non-monetary perquisite exemption, is available under section 10(10)(c). The another one is TDS under section 194N, which we just now saw. Foreign taxes also need not be a deemed income, and TDS under the GST law is also not a deemed income. That brings us to Section 199. What does Section 199 say? Let me run through subsection 3, which is the one what we are going to discuss on. Subsection 3 of 199 reads, the board may, for the purposes of giving credit in respect of tax deducted or tax paid in terms of provisions of this chapter, make such rules as may be necessary, including the rules for the provisions of giving credit to a person other than those referred to in subsection 1 and 2, and also the assessment year for which such credit may be given. So section 199 makes it very clear that the rule is made, and the rule is 37BA. Plus, further it goes also the assessment year for which the credit may be given. So, in which assessment year the credit should be given is also given in the respective rule. Coming to what does Rule 37BA say? Credit for tax deducted at source and paid to the central government for the assessment year for which the income is assessable. So, here again, I am putting the stress on the word assessable. Where tax has been deducted at source and paid to the central government and the income is accessible over a number of years, credit for tax deducted at source shall be allowed across those years in the same proportion in which the income is accessible to tax. So these both clauses are important for solving our further queries. And a similar rule 37I also provides for credit of tax collected at source. For our better understanding, I have prepared a case study, and the case study is regarding the year in which income is to be considered and credit for TDS to be allowed. That is the case study on. So let us understand what the case study is. Year of, say it's Mr. A chartered accountant, who is following cash system of accounting. He had taken audit assignment of PQR Limited for the financial year ended 20, wherein audit fees was decided at rupees 50 lakhs. On 31st March 20, PQR Limited made a provision for audit fees of rupees 50,000 in the books of account and deducted and deposited TDS of rupees 5 lakh. The said TDS is duly reflected in Form 26AS of Mr. A for the assessment year 2021. So, for our convenience sake, assessment year 2021 is the year 1. The audit was completed and invoice was raised by Mr. A on 31st of August 2020. In financial year 2021, Mr. A received a check rupees 22 lakh 50,000 from PQR Limited. So that is year 2. Financial year 2021 is our year 2, where he receives 22 lakh 50,000. Mr. A did not receive any payment thereafter. PQR Limited is under NCLT and the balance payment is not receivable as per the order of NCLT received in financial year 23-24. Now, what are the options available to Mr. A? One, when he should show the income and how he should take the credit. For that purpose, we have already run through the two provisions, that is section 198, 199, and the relevant rule, that is 37BA. So let us understand what are the options available. The first option, what could be available, would be in the year 1, the year in which the PQR Limited had made the provision and deducted tax. In the assessment year 2021 year 1, Mr. A makes an entry in his books of account of rupees 5 lakhs, that is the TDS amount. He debits TDS and credits the professional fees and thereby claims TDS of rupees 5 lakh in computing total income for assessment year 2021. Why he does that? He tries to interpret section 198 saying that it's a deemed income of, because section 198 we just saw few minutes back, it says it's a deemed, the amount, the tax deducted is the amount of deemed income. Therefore, he treats this as as an income by crediting professional fees. And however, since the income is offered, he is taking the credit also as per section 199. This is what his interpretation is. However, when we come to option 2, we see that the auditor of Mr. A, he raises an objection that this journal entry passed in option 1 above cannot be made as Mr. A is following cash system of accounting. Since he has not received any payment, you cannot make this journal entry. Therefore, Mr. A does not pass any such entry in his books of account. But however, he wants to comply with these two provisions. Therefore, he makes an adjustment in the computation of total income. So in the year 1, he adds in his total, in his income from profession, that is business and gains, he adds rupees 5 lakh as income and he takes the credit of rupees 5 lakhs as the TDS credit. When he comes to option 3, in assessment year 21-22, that is in year 2, on receipt of 22,50,000 by check, Mr. A passes an entry in his books of account crediting professional fees by rupees 27,50,000. Why 27,50,000? 22,50,000 is the amount of check he has received and 5 lakh is the TDS amount. Aggregating to that, he credits professional fees by 27,50,000. Thereby, in assessment year 21-22, Mr. A is claiming TDS credit of rupees 5 lakh after offering an income of rupees 27,50,000. There is one more option available, which is option number 4. On receipt of this 22,50,000 by check, Mr. A passes an entry in the books of account and he credits 25 lakhs. 25 lakhs is the 50% of the fees he has received, which is 22.5 lakh by check and the same equivalent proportion of the TDS amount. So therefore, he will be showing the professional receipt as 25 lakhs and claiming the TDS of 2,50,000. Now, till date, Mr. A has not received balanced professional fees of 25 lakhs, which includes the TDS amount of 2.5 lakh. Then in option 4, Mr. A will have to forego the TDS of rupees 2,50,000. Can he claim saved credit in assessment year 24-25? Because as we saw that as per the order of NCLT, which was received in financial year 23-24, relevant to assessment year 24-25, that he will not be getting any amount. Now, since it was decided or he was sure that he is not going to receive any amount, can he take the credit of 2.5 lakh? That is an issue. As far as a circular number 5 of 2001 dated 2nd March 2001, though it is issued in context to the advance rent and a subsequent cancellation of that rent agreement, wherein CBDT has clarified that TDS credit in respect of advance rent, wherein agreement is subsequently cancelled, shall be allowed in the year of cancellation or termination of rent agreement and refund of advanced rent. Whether the same analogy can be extended, because here also in the respective year, that is SS20 or 24-25, he is not going to get any amount, and therefore it is as good as getting it cancelled. And whether he can claim, this can be a definitely option one can try and explore to that. Now, before coming to which option is the best option or the better option available to Mr. A, before coming to our decision, let us understand what are the judicial pronouncements which has come and which will support to our which will support our decision. In the case of Vasha Salunke, the Bombay Tribunal, which is reported in 98 ITD 147, it's a third member judgment, wherein it said that section 198 and 199 does not in any way change the year of accessibility of income, which depends on the method of accounting regularly employed by the SSC. These sections only deal with the year in which the TDS has to be given, the credit for TDS has to be given by the assessing officer. The another decision is Toyo Engineering India Limited, reported in 100 TTJ 373. This is also a Bombay Tribunal decision. This decision here, the company was following project completion method. The taxes were deducted during the ongoing project period. The company Toyo Engineering, they had claimed the TDS credit. However, after the project is completed, the income is offered to tax. When law has used the words in section 199 that credit shall be given for the tax deducted at source on production of the certificate, because in those years the certificate form number 16A were required to be produced, or the TDS certificates were required to be produced, and based on that you would be getting the TDS credit, for which such income is assessable. It implies that the nexus between TDS and corresponding income element would remain rather notional and conceptual. Therefore, in Toyo Engineering, if you see that the direct nexus between the TDS of income and TDS income and the TDS would not be necessary. Let us also run through few more decisions to understand what possibly our decision should be. In the case of Pradeep Kumar D, again a third member bench, this is of the Chandigarh Tribunal, which is reported in 107 ITD, page 118. If instead of the entire income referable to amount of tax deducted, only a portion of income is found assessable, then the benefit has to be allowed only on the portion shown. So that means here is trying to say that you will be allowed the TDS credit of only the proportion income which is offered to tax, and or rather which is accessible in the year in which the income is shown. In the case of Chandra Shekhar Agarwal, which is reported in 67taxman.com, page 62, Delhi Tribunal, there it said this rule 37BA is only applicable where the entire compensation is received in advance, but the same is not accessible to tax in that year, but is accessible in a number of years. As we just read this rule 37BA, it is the second paragraph which talks about this. The first paragraph doesn't talk about this, but I don't know, somehow the tribunal got tilted to the second paragraph, and there it said that if you have received in advance, only there this rule is applicable. Rule 37BA cannot be interpreted so as to say that tax deducted and deposited to the account of central government is though income of the assessee, but is not eligible for credit in the year when such TDS was offered as income. So it is trying to say that there may not be any nexus, so he may not get the TDS credit. In the case of Sundar, and similarly, these two decisions were also supporting the other decisions what we just read. Now coming to that, okay, after running through all these decisions, which we saw that there was a conflict. Now to summarize, in year one, PQR makes a provision, entry and deducts tax. In year two, Mr. A renders service and receives 50% of payment. No fees is received for the balance 50%. So the option one, in year one, Mr. A doesn't receive the fees. However, to meet the provision, he has made those adjustments first in option one in the books of accounts, in option two outside books of accounts. Making such entry of TDS and claiming the TDS credit of under section 199 in the books of account, treating it as a deemed income for 198. So according to me, and as we read down the various decisions, which very clearly says that it depends upon the method of accounting you are following. Here, Mr. A is a chartered accountant and he is following cash system of accounting. So the question of treating that as income even under section 198 will not arise. It will be deemed income the year in which the income is received, and he receives that income in the subsequent year, that is in year two, and that to 50%. Therefore, option 1 and 2 both are not a good option that one should opt for. Coming to option number 3, which says that 50% of the amount is received. Yes, as far as income taxability, there is no dispute. The question comes, how much income he should offer? Should he offer 27 and a half, that is the check amount plus the entire TDS amount? Or as per option 4, should he offer 25 lakhs? That's the proportion option. So that we can have a option number 3 or option number 2, option number 4 as a better option. But as you know, we need to take a call which one would be a better option ultimately. So after interpreting the I would say rule 37BA, as well as the provisions which are as judicial pronouncements which has come, say for example, when we started with Varsha Salamke, there, according to them, the TDS credit, if the income offered is more than the TDS credit what you are claiming, in that case, definitely you can take the entire TDS credit of rupees 5 lakhs. So I would rather say that yes, the option 3 is a better option, and more so when if you try and apply the rule which the circular which is on the rent which we just discussed few minutes back, that the departments may say that look, this is specifically restricted only for the purpose of rent act, and there is no cancellation of the contract, so you may not get a credit. Here I have referred to this is only in case if you have missed the bus, and then you can try and make your claim of TDS the year in which you are sure that you will not be receiving any amount. So I have given my view that option 3 is a better option as it meets both the provisions of section 198 and 199. Now that brings me to one, not a controversy but a good provision which has been introduced by section 155 subsection 20, and which talks about TDS credit for income already disclosed in the return in the past year. For easy understanding, I have taken this by way of a small example. Mr. David, it's a Rahul David, a professional cricketer. Well, it actually doesn't apply. These are just resembling names. Mr. Rahul Dravid has raised a bill for professional fees of rupees 20 lakhs on Mr. Rohit in assessment year 20 to 23. Mr. Rohit made full payment of rupees 20 lakhs to Mr. Dravid in assessment year 20 to 23. Subsequently, Mr. Rohit deducted tax under a tax at source under section 194J in assessment year 24-25, that is after 2 years. Maybe he must have got a notice of an SSC in default and he was made to make that payment, and so he deducted TDS, or maybe he got his accounts audited later on. The auditor pointed out, for whatever reason, he had to make the payment, deduct the tax, and he has deducted, and thereafter he issued the TDS certificate to Mr. Reddy. The said TDS is reflected in 26 AS of Mr. David in assessment year 24-25. Now, Mr. David can make an, because of this provision, he can make an rectification application in the prescribed form, that is form number 71, which reads with Rule 134, to the assessing officer within 2 years from the end of the financial year 23-24, that is the year in which this tax is deducted, for amendment of the order of assessment and allow credit of the tax in relevant to the assessment year 20-23. That is because he has already offered that income, the taxes have also been paid, and he is going to get a credit of 20 credit of this for assessment year 22-23. The small controversy, which is not clarified by way of this either section or some circular, is that whether Mr. Dravid is eligible for the interest on this refund, what he is going to get, because it will start from assessment year 20-23, whether he is eligible. If I am supposed to interpret the law, then yes, he should be made eligible for the purpose of interest. The reason is simple and logical also. Mr. Rahul has been penalized by way of interest also when he is submitting the TDS, depositing the TDS, which is relevant to assessment in 22-23. In that case, he would be paying the interest, and therefore, in all fairness, he should be allowed interest. But I am not too sure, and it has not been tested by my office also, so we don't know. But nevertheless, the TDS is definitely as per the section 155 subsection 2, which will be allowed, but make sure that it has to be done within 2 years. That brings me to a new provision, not a new provision, but a very recent one which has been introduced in last 2 years. I have tried to take up those ones, and there are many controversies on those, and that is 194R, TDS on benefit or perquisite in respect of business or profession. A small background on this section. This was inserted by Finance Act 22 with effect from 1st July 22. Any person responsible for providing to a resident any benefit or perquisite, whether convertible into money or not, arising from business, let me read again, arising from business or the exercise of a profession by such resident shall deduct TDS at the rate of 10% on the value of the perquisite for the benefit that has been offered. In case a benefit or perquisite is wholly in kind or partly in cash or in kind, and if the cash is not sufficient to meet the liability of TDS, then the person providing the benefit of perquisite must ensure that the tax required to be deducted is paid before releasing such benefit or perquisite. So it is the liability of the deductor that he ensures that the tax required to be deducted is deposited. Threshold limit over here is 20 lakhs, which is a very small amount if you ask me. And the explanatory memorandum, when this section was introduced, said in many cases such receipt does not report the receipt of benefits in their return. So the recipients, that is the SSE, does not report the receipt of benefits in their return of income, leading to furnishing of incorrect particulars of income. I do agree with this explanatory memorandum that we have seen number of times, and more particularly in professionals, whether it is some personality model or it's a doctor or for that matter any other professional, maybe even a chartered accountant. We have seen that the perquisites what they receive in kind, not in cash, when they receive it in kind, those perquisites are, though it is received when it is arising from the business or the exercise of the profession, more the highlight would have been more so when the freebies are offered to the medical practitioners. They are offered some holidays or some car or watches, etc., etc. And those are not treated as an income by those professional or by the recipient. And here this section is introduced to say that if the value of those perquisite exceeds rupees 20,000, the company or the person is required to deduct tax at the rate of 10% under section 194R. Now, simultaneously, friends, we already have a provision of section 28(4), which is a very old provision and which was inserted by Finance Act 1964. There it said the value of any benefit or perquisite, whether convertible into money or not, arising from business or the exercise of the profession. So this provision is an old provision since 64, which says that there is a charge and which is treated as an income for these perquisites and benefits. The CBDT in 64 stated that the benefit arising from business, everywhere, friends, if you see whether it's a circular or it's a law, arising from business or profession should be in cash or in kind. The intention of the legislature was to tax the benefit or perquisite whether it is in cash or in kind. This very technical, whether it is in cash or in kind, and what we mean by that, this was addressed by Madras High Court, and there it was held that it is not the actual receipt of money, but the receipt of a benefit or perquisite, which has a monetary value. Whether such benefit or perquisite is convertible into money or not is not covered by section 28(4). Amount representing principal loan, amount waived by the bank under OTS, that is one time settlement scheme, would constitute income falling under section 28(4). There the issue before the Madras High Court was in the case of OTS, when there is a settlement, the lender waives off certain, there is a haircut and he waives off certain amount of certain principal amount. Whether that principal amount is a perquisite, the Madras High Court said yes, it is a perquisite and which is required to be taxable as per the provisions of section 28(4). However, this said analogy was subsequently reversed by Supreme Court, a very well-known decision in the case of Mahindra and Mahindra, reported in 255 Taxman 305, wherein the Honorable Supreme Court has categorically held that in order to revoke the provisions of Section 28(4), the benefit which is received has to be in some other form rather than in shape of money. As waiver of loan is a cash receipt, Section 28(4) does not come into picture. So there, as per the Supreme Court, it says that Section 28(4) will not apply to the waiver of loan. So even in case of OTS, this will not apply. So it is overruling the decision of the Madras High Court. Where does the complication start from? Circular 12 dated June 22 which is stating the section 194R of the Act clearly brings in its scope the situation where the benefit or perquisite is in cash or in kind or partly in cash or partly in kind. Why I am directly relating to the provisions of section 28(4) is because the wordings used in section 194R are identical to what was there in 194, to there in 28(4). Explanation 2 was inserted to section 194R by way of Finance Act, that is after this circular. To give teeth to this circular, this provision was introduced. And it read, that is for the removal of doubt. That means they want to make it applicable retrospectively. It is clarified that the provisions of subsection 1 shall apply to any benefit or perquisite, whether in cash or in kind or partly in cash or in kind. The waiver of loan is in cash. The Supreme Court in the case of Mahindra held that the cash is not covered by 28(4), and hence the provisions accordingly 194R will also not apply. To overcome that, this is the explanation which is introduced. And section simultaneously thereafter, not simultaneously, from Finance Act 23, that is the subsequent, but with effect from 1/4/24, they substituted section 28(4), and which read the value of any benefit the value of any benefit or perquisite arising from business or exercise of profession, whether convertible into money or not, or that is the second bullet they have taken, in cash or in kind or partly in cash or in kind. So in nutshell, I can say that based on the decision of Mahindra, whether the benefit of cash could be covered under 194R as well as 24R, though the CBDT circular have taken a different view, and subsequently section 28 is also amended. That is a controversy what has arisen and that we are all facing today still. So the issue for consideration, does the said landmark judgment still hold good post amendment to section 28(4)? Whether benefits received in cash, that is up to 31st of March 23, will not be covered by 28(4). To get covered under 194, the benefit perquisite should be arising from business or exercise of profession of receipt of such benefit. That is what I have been stressing on, that what does section 194R and 194 28(4) talk about. Now, before we come to applicability of TDS on waiver of loan, we have let us understand that will it make any difference whether the loan is a term loan or a working capital loan? For the applicability of 194R and 128(4), per se, if you ask me, it should not make any difference. The taxability would be there. However, when we take up a small issue is there, I will be covering over there. What will not be covered? See, there is a decision of Karnataka High Court in the case of IG Petrochemicals Limited, which is reported in 155taxman.com, page 45. The conclusion of this judgment is that as a simpliciter, normally we advise a conservative view and do not enter into any controversy. And that's a normal principle when it comes to the TDS part. And which says that it is better we deduct TDS and sleep peacefully. That is a normal, I would say, understanding what we chartered accountant. Saying that you deduct TDS, you will get a credit later on, whether it is a higher rate of TDS, not required, still I have deducted. That's all. But then it is an additional burden on the lender. Because here, what happens in this case particularly, this philosophy, I would say, would not be a good philosophy to apply, is because here, first of all, the lender is taking a haircut. He is not been able to receive the amount. Secondly, when he's deducting TDS on that, that is an additional 10%, which also he is doubtful or rather he is not going to receive. So it's an additional burden on the deductor. Therefore, what will not, as per the Karnataka High Court decision, IG Petrochemicals Limited, as I mentioned, what will not be covered is a waiver of law, not arising from business or the exercise of a profession of borrower. This is unlike a salaried employee, waiver of housing loan or a vehicle loan. There is no dispute, and in those cases, this will apply. The provisions of perquisite. I'm sorry, there is a very clear that this would not apply. The clarity being that this housing loan and a vehicle loan, if it is his individual capacity not coming from his business, then there is a straight away that it is not arising at all from his business. It's for his personal, and therefore the question of 28(4) or 194(r) would not apply per se at all. If it is for the business, whether it is arising from the business, that is the whole crux that we need to understand. Let us understand few judgments before we take up before we conclude this controversy. The Honorable Supreme Court in case of Universal Radiators reported in 201 ITR page 800 has held that benefit or perquisite should arise from business or exercise of profession. An income directly or ancillary to the business may be an income from business, but any income to an SSC carrying on business does not become an income from business unless the necessary relationship between the two is established. In the case of Gujarat High Court, Bhavnagar Bone and Fertilizer reported in 32 Taxman 180. There also it was held. Amount received had no connection or nexus with the business of the SSC. It did not represent the value of any benefit or perquisite arising from the business of the SSC company. This amount, therefore, would not partake the character of income. Allahabad High Court reported in 114 ITR, page 840, also covered the same issue, and that it mentioned that it should arise from the business. If it is not arising directly from the business, in that case, it would not be treated as 28(4) and 194 would not apply. So, in the present case, if we have this controversy, it cannot be said the SSC company or the SSC, if is not carrying on any business of obtaining loan and the remission of such loan by the creditors of the company was a benefit arising. So, to summarize, if the SSC is in the business of advancing loan, taking loan, and for taking this loan, if there is a haircut or OTS, in such case, that would be arising from the business. If my business is of, say, manufacturing automobiles, and I have taken a loan, I am of this opinion after considering this, I would say, pronouncements of Supreme Court and various High Court, it would not be treated as an income under 28.4, and it will also not be covered as a benefit or perquisite in cash for the purpose of 194R. I am aware about that. Yes, there is a strong different view which is saying that no, after the amendment to this law and more particularly after the decision of Supreme Court in case of Mahindra and Mahindra, this becomes a taxable amount and covered under 194R also. That brings to other issues which are applicable very rapidly. I would give my answers to all. I will not be able to give the reasons for why I am coming to this answer, and that is on account of paucity of the time. Okay. I would request Mr. Junjunwala to just tell me 5-10 minutes before, so that I could wind up for the purpose of taking up the questions over here.
Yes, definitely, sir.
Yeah, please. In the meantime, let us take up the controversies which are there as in issues for 194R. Can a guarantee provided be said to be a benefit or purchase in the hands of the personal guarantee what is provided? The answer would be no from my view. However, it is still debatable because it is for business or profession and not from business or profession. That's the difference. If it is for business or profession, no. It is from business or profession, then only TDS is required to be made. And however, if it is treated, if somebody is of the opinion that no, you are required to deduct TDS on that, then the question of valuation will be there. And in absence of any clarity, TDS will be withheld on the guarantee fees paid or the valuation to be done as per the transfer pricing method, what we normally adopt for the purpose of transfer pricing. The second one is brand building products, wherein a dealer normally is displaying or telling the distributor to display a signboard, a statue, stationery, refrigerator, standees, dangler, wall clock, etc. of the company with the logo of the company, with the name as per the requirement of the company, and where it should be displayed in the shop premises or the display showcase of the dealer. Whether it would be treated as a perquisite or a benefit, the answer to that also is a no, because it is a contractual obligation, and as such, no such benefit or perquisite is there in the hands of the dealer. I can understand that one can say that when you are putting up a wall clock, then definitely you are seeing the timing, so you are making the use of that wall clock. But I understand that is not the purpose of displaying the wall clock. The purpose is the contractual obligation. Displaying is the logo of that company or the make of that company. Interest-free loan or advances, whether that would attract 194R, the answer is no, not a benefit or a perquisite arising from the business. In addition, it is a commercial arrangement between the two parties. My answer would not differ whether the loan is a borrowed loan or not, because if it's a borrowed loan, then that would be relevant for the purpose of section 36(1)(3) and not for the purpose of 194R. Bad debts written off or provision for bad debts. Provision for bad debts, definitely no. But bad debts written off, whether it is a perquisite or a benefit, it can be argued that section 194R requires TDS on for income covered by section 28. Since write back is deemed to be income under section 41(1), the same cannot attract TDS implications because it's an income under 41(1). It cannot be treated as an income again under section 28(4). However, I am aware of the FAQ given in the circular and which takes a contrary view to what I have just mentioned. Okay, then we come to whether in insolvency proceeding, acquisition of undertaking, whether wherein a haircut is given. We have already discussed this in length for the insolvency proceedings, and the answer to my view is still a no. Short payment made on account of liquidation. It's on the same analogy that it does not emanate from business and profession, and therefore no tax should be deducted on under section 194. Rendering of services to sister concern. Well, as such, the answer is yes. It should be, because it is a benefit that the recipient is getting. If it's a benefit, then why no provision? It should be yes. But however, implementation would become very difficult. But I won't be surprised that the department will makes up a case that there are certain valuation rules available akin to what GST law or the transfer pricing law is there, and why those cannot be made for the valuation purpose. The another one is the company hires an advertising agency for promotion of its products, and in the promotion scheme, agency provides free coupons to the customers. The answer would be no, as such advertising agency is just an intermediate. Benefit provided by the company to customers. In hands of customer, it may or may not be arising out of business. If assumed to be yes, then again it would be very difficult to implement this provision. So this is coming out of directly from the section provisions what are there. Then after further complications came up is because of the circulars which were issued. There were total 3 circulars which have been issued for so-called clarification, and they said to remove difficulties in implementing the provisions of section 194. These circulars are there. Certain important points of CBDT circular dated this are just highlighted, which I would just run through very rapidly. Deductor is not required to check if the benefit or perquisite he is providing is covered by the recipient under section 28(4) or not. Circular is for removal of difficulties in the implementation of the provisions. Section 194R is applicable even if the benefit of perquisite is in the form of a capital goods amount paid as per consent decree, gift of car, land, etc. Because these are the capital goods, capital items. However, they have said that it is applicable, which I fully agree. Sales discount, cash discount, rebate allowed to customer from the listed retail price. 194R is not covered, not required. And the reason given is because this will be very difficult to calculate, to implement, and that's the reason. Otherwise, per se, according to them, it should have been made applicable. The small issue would arise is then applicability of on loyalty discounts, quantity discount, portal discounts, road discounts, etc. Whether 194R would be applicable, because the reason is not satisfactory. And if only applying this reason, I would say then it should apply. 194 would apply for the purpose of loyalty discount or quantity discount. However, understanding the law, I would say that no, it should not apply, because that is a contractual understanding that when I am making these purchases, I'm sure that I would be exceeding this amount, I would be getting a quantity discount, plus I would be getting certain incentive. The same would accrue after a threshold limit is achieved. But that does not mean that, and to achieve that threshold limit, one would carry on that business to that limit, and thereafter we would get that discount. So that discount is already factored in his purchases. The purchases are reduced, and thereby the income has already been considered or factored when these discounts are received. And therefore, in my view, one need not considered this for the purpose of deduction of tax under 194. Free samples given to distributors or retailers, which are further to be given to the customers. In hands of these distributors or retailers, there is no benefit. The benefit is provided by the company to the customer. In hands of customer, it may or may not arise out of business, and hence there would not be any requirement to deduct tax. Now, certain issues in case of restructuring of a loan by way of modification of terms of repayment benefit arises. I understand there is a benefit that what you were to pay tomorrow, you are going to make the payment after 2 years or 3 years or in a more scattered fashion. But this benefit is just not an, I would say, given by a compulsion that one had to give this as an option if you can adopt this. So I would personally feel that this should not be arising as a benefit under 194R and no tax is required to be deducted. Benefit of perquisite in a group activity wherein it is difficult. Group activity means, I mean to say that a company is taking a group of 100 people outside for the purpose of a conference or an entertainment or whatever it is. In that case, and they incur an expense of 1 crore rupees. Well, there is a direct benefit to the person who is receiving or person who is participating in that outdoor activity. And this 1 crore is for that 100 people. There is no direct nexus between these people. For that purpose, our circular issued by CBDT has given an option that if you are unable to allocate this amount per participant, in that case, and I understand these participants, since they are the dealers, and that's the reason that they have been taken to a place for their entertainment purposes, then there is a benefit, and which is arising out of the business. Therefore, TDS 194R is applicable. But how do you allocate that to the 100 people? Therefore, the circular says, in such cases, if it is not possible, then you do not claim this expense. So the company should not claim this 1 crore rupees as an expense, and therefore 194R will give you a relaxation. Sounds very stupid to me. The reason is, assuming that company is paying 25% tax, is on the slab of 25%. So 1 crore rupees, I'm not talking about not considering surcharge and cess for the moment. So this 25 lakh is the direct outflow what he is going to make from. Then what is an option? Then we come to option number 2, which says that let us follow the provision. And what does that provision say? That okay, since I have not deducted TDS on that, you will disallow the 30% of my expense. And the 30% of that expense of 1 crore will be 30 lakh rupees. And on that, I need to pay 25% tax. So that comes to only 7.5 lakh instead of the 25 lakhs which otherwise I would have been paid. But mind you, what is important over here will be that you still would continue to be an assessee in default under section 201. And if you are an assessee in default, the officer, the department may still tell you that you are supposed to deduct the taxes and pay the same. So then what is the best option available? We have another option, that is option number 3, is saying that let us follow the section. The section says that you are supposed to deduct the TDS and deposit. So I will deduct 10%, which will be 10 lakh rupees. So my outflow is 10 lakh rupees. I deduct 10 lakh rupees and I deposit the same. But I do not include that in my TDS statement, which I am filing quarterly. And I have a reason of not including tomorrow. If the department comes and tells me that why you have made an incorrect statement in your TDS return, then I have a reason to say I was prevented by reasonable cause. And that prevention was that I could not allocate it. However, as my liability was to deduct TDS and I have deducted it, what is happening is the person who is supposed to get the credit, he will not get the credit. And I'm sure the law or the court would say that yes, something which is not possible for a person to do, you cannot compel that businessman that you are supposed to carry on. And hence, I understand that there would not be any penal provision also. But what I'm trying to bring out in this entire discussion is see these type of provisions which are really very difficult to adhere to, difficult to implement, and they are trying to come out with a circular saying that it's for the purpose of simplification and these problems are getting aggravated. Okay, that brings me to another small issue on issue of bonus shares and right shares, whether there is any element of benefit of perquisite. To me per se, definitely not. There is no, because it's an intrinsic value of those shares. But the circular clarifies only for company in which public is substantially interested and shares are issued or offered to all the shareholders. So therefore, the question will come up that in case of a private limited companies which are not listed or not substantially public are not substantially interested, there 194R would arise according to this circular, yes, but according to me, still the answer remains no, because intrinsic value of those shares still remains the same, unless the right shares are disproportionately issued to the existing shareholders. So if the right shares are not issued evenly in the proportion of the existing shareholding, then there would be a benefit to certain shareholders and certain may not have that benefit. There the question of 194R to that extent would arise. Okay, that very
So,
rapidly brings me to, yeah.
yeah, just an update. Last 10 minutes.
Okay, last 10 minutes. All right. I will try to wrap it up a little faster. So 194Q, friends, we have, which is on TDS on payment of certain goods, certain sums for purchase of goods which has been made. I would just take up the controversies and understanding that the people are aware of these provisions, and we will just try to run through. I would just skip this. What this when was this introduced? The rate of TDS is 0.1%, and it is the threshold limit is above rupees 50 lakhs, and the person if the buyer's total gross total sales of the turnover in the preceding financial year was 10 crores. However, it's an exception given is that if tax is deductible under any other provision of Act, then you need not deduct under 194Q. And if tax is collectible under Section 206C 1H applies, then there is TCS on sale of goods. There also, if it is already been collected, you need not deduct tax under 194. Unfortunately, the memorandum explaining this provision, why it was required, there is no rationale given in the entire memorandum when this was introduced in Finance Act 21. And to me, if you ask me, though we have made the representation this budget for this budget also that in fact both these sections 206C1H and 194Q are creating some complications. They are getting conflicts, and in certain area they get into conflict, and therefore it should be done away with at least either of one of them. Well, very logically, if you ask me, it is not required because there is no reason given that it should continue. Let me straight away come to the issues. The section itself has a proviso which says that 194Q will not apply to securities and commodities which are listed and which are recognized under the International Financial Service Center. Second, it talks about transaction in electricity, renewable energy certificates, only if it is through power exchanges registered. Therefore, to where the electricity is provided by private companies, this would exception would not apply, and 194Q will apply to them. Purchase of goods from seller who is exempt from income tax, there also 194Q would not apply. To a non-resident, it would not apply. And for wherever it is for the first year of incorporation, there also it will not apply because it does not have a limit of rupees 10 crore. It does not satisfy, so it would not apply. Unfortunately, the term goods is not defined, and therefore we start referring to the various meanings of this term goods under different statutes. Constitution of India says something else. Our GST talks about something else, and our Sale of Goods Act talks about something else. However, we would not refer to the Constitution of India because that is something which is not akin to what our taxes issues. So either we take up Sale of Goods Act or we take up GST. The major difference between the two are regarding the actionable claim. In the case of GST, it says that actionable claims is part of goods, whereas when it comes to Sale of Goods Act, it says that actionable claim is not part of the goods. Therefore, there is to that extent a conflict whether they would form part of goods and TDS is required to be deducted or not. We have a apex code in the case of Tata Consultancy where the goods provided, and I think we should make this as a benchmark to determine whether it's a goods or not for the purpose of Section 194Q or not. And it says provided it is an attributes like its utility, capable of transmitted, transferred, delivered, and it can be in the possession. So, in this background, let us understand whether it would be goods for the purpose. Though we have another decision also in the case of South BR Sugar Mills, there also the goods have been defined. And another one is for BSNL, wherein the electromagnetic waves, where it was held that by the Supreme Court that this is not a goods for the purpose of it's not a goods, and therefore the provisions of 194Q would not apply. Okay, coming to some very rapidly certain issues which I have just brought down over here is first of all is whether goods would include only principal items of business or will include items like consumable stationery, fixed assets, food items, including water. The answer is a clear-cut yes, it would include everything. Then we have slum sale, whether it is to be treated here, the answer would be yes and no both. More so that because in the case of slum sale, there would be some assets what a person is going to get would be immovable properties also. And as we just saw, the goods would not include the immovable property. In that case, the answer would be clear cut no, since it's an immovable property, it's includes, so it would be no. But if there is no immovable property, then whether it would be treated as a goods. If I have to apply the proportion or the given analogy given by the Supreme Court in the case of Tata Consultancy, in that case, yes, it should be held as a slum sale, but definitely very difficult to calculate, and more so, one will, if supposing a person has missed it or he doesn't want to deduct, then one should be able to take the benefit, saying that by no scratch of thought also there is an income embedded in this entire 194Q income embedded in this transaction of slum sale. and therefore no TDS should be applicable, as we just saw in the starting when Section 4 was there, when we read Section 199, wherein it said, and 190 also, wherein it said that there has to be some income embedded to make the provisions active. A jewelry purchased by a proprietor for personal use. When I'm saying purchased by the proprietor, means I understand the other conditions of that, the proprietor business and the purchase amount is exceeding, though it is for his personal use. But because that person is covered under 194Q, he would be defined as a buyer and it would fall for the provision of 194Q. Foreign currency money is not treated as a goods and therefore not applicable. Unlisted shares, as I said, yes, it would fall because of the circular when it is offered to that. Actionable claim, very clearly it excludes. I have already considered, and though there is a conflict, but if I have to apply the provision, the analogy laid down, the test laid down by the Supreme Court in case of TCS, in that case, it is definitely a utility capable of being brought and sold and capable of transmitted. Then the answer to that is a yes, and therefore it should. And the GST law also says it should be covered. So we would rather more say that it is covered as a goods. Works contract, I would say that Section 194C shall apply and not 194Q. And as we saw that if one section is applicable, the other one, this 194Q would not apply. Similar applies to the composite contracts. Import of goods, clearly, the section is very clear. It is responsible for paying any sum to any resident. And I understand the import of goods, the foreigner is not a resident. High C sales transaction. Here one needs to be careful that high C sales, if it is to the resident, that yes, it will apply the buyer if he's a resident buyer, and other conditions are being satisfied. For the remove, similarly, how we had for 206, the same way we have for 194, for 194R, we have for 194Q also, certain circulars issued. The circular which talks about whether the GST even amount should be included for the purpose of this. There, though they have said that if it is separately shown, you need not do it. If it is not shown, if it is for advance payment, then you're. But I understand if you can very clearly identify the GST amount, you need not deduct TDS on the GST element. As far as the purchase returns are concerned, the circular is giving us, on the contrary, more conflict than for a solution. And it says that if there is a purchase return, the money is refunded to the seller, then the TDS on such purchase returns may be adjusted against the subsequent purchase. But he has not taken into consider what happens where the amount is not refunded by the seller, which is going to be adjusted in the subsequent purchase, or if there is no subsequent purchase per se at all, then what would be the situation? Those questions have not been addressed by that. But however, I understand that one can revise the return in those cases and very rapidly and try and say that the provisions of 194Q are not made applicable. So this is on the purchase return. I would, for want of time, there is certain one more. I would skip this tax collection at source because I have tried to cover in 194Q because it is the almost, you would say, the other replica of tax deducted. The major difference is in the case of tax collection. Here it is on who receives an amount as consideration and not when he makes the sales. So because of that, there has been a conflict, certain areas between the buyer and the seller. At times, you will see that the buyer will ask for the deducted in year one, whereas the payments are realized in year two. The TCS, whether to be deducted, the threshold limit, whether to see that time independently or not. Those issues are not solved, and this the time of the courts will try and come out with some pronouncements on that, and maybe we solve these issues. Transactions involving sale of capital goods such as fixed assets are covered. The answer to that is yes, that it is covered. Whether TCS to be added on invoices, well, or a separate debit note, both the procedures are accepted. There would not be any difference. It depends upon the policy or the SOP that a company is following. Similarly, we have TCS to be collected on GST. The answer is clear no. I have given my view on when I was there on 194Q. TCS on advance sales consideration and subsequent refund without sales. The same problem arises. It is more, however, so I'm sorry. Here the problem is not that the reason is it is on the consideration base. Whenever there is a sales made, that time you do not have to deduct TCS, collect TCS. It is on the sales consideration where it is. Similarly, interest received from debtors. Okay, interest received from debtors. Well, as such, if you say there somebody would say that is this interest not covered under 194? Then the 194A. Then the answer to that would be no. It is not an interest which is under section 2, subsection 2, capital B, capital A. It is therefore to be deducted under collected under section 206. Over here, what we are discussing. Sale of motor car, yes, we have to deduct. Here the conflict will be the sale of motor car is that there is already one provision, that is 206C1F, but that says that if the value of the car exceeds rupees 10 lakhs. So if a person is selling the car below 10 lakhs, 9 cars or 6 cars are sold to people, to a particular people, the aggregate, and each car is say valuing 9 lakhs, the aggregate is 54 lakhs. Whether he is required to deduct TCS on that under 1H, the answer is that yes, since he is not required to deduct under 1F, so therefore he will have to deduct under 1H. Saying the sale of immovable property, the clear answer is no. Recovery of bad debts. Here, since it is collected, if it is not collected, if it is not collected earlier, so whenever there is a collection, you are supposed to collect the TCS, and therefore it is on the receipt basis. We need to collect the TCS on that. Okay, I would script this because not applicable to majority of them. That is regarding the LRS. There are certain issues on that LRS. More so, the issue would be that whether TCS is at all required to be collected. Because as we read, there has to be some income embedded to it. If there is no income, it is your own money. If you are if you are giving it for your daughter or children's education, or your medical treatment, it is your own money, which is tax paid money, and hence there should not be any TCS provision applicable. But here we have LRS provision there on the statute and requires to be deducted. I don't know by any chance my slides are, if they can be uploaded, and for the benefit of the person, if he wants to, he can just run through those afterwards after if it is uploaded by the organizer. There is a conflict on certain areas which I just mentioned between section 194Q and 206(1)H. Similarly, there is a conflict between 194O, which is on e-commerce operator, and 194Q, which are still not unsolved. Consequences on failure to deduct deduct TDS, I would just try to skip for want of time.
Yes.
But only one thing which I'm tempted to, and which is very interesting to note, is section 271C does not cover delay in deposit of tax deducted at source. So if there is a delay in deposit of tax deducted at source, in that case, there will not be any penalty under section 271C, and this is also supported by the judicial pronouncement of I think this is US Technologies International Private Limited, and this pronouncement very clearly says that 271 capital C, there shall not be any penalty leviable under this on mere delay in remittance of TDS. after deducting the same by the SS. However, and I don't know why it had to still get it stretched, but they said that, however, the consequences of on non-payment belated remittance would be under section 2011A and 276B, that is the prosecution provision would apply. So that one needs to be careful about. Very rapidly, in the last 5 minutes, I will try to cover. I understand that I'm extending, Mr. Rohit, but
Yes,
this
sir.
is something which everybody would be very much concerned about. So I would
Okay.
try to cover up this in operative pen. This section 190, 139 AA, which was notified by 1/4/2023, it was there on the statute, but however, it kept on getting extended and it was notified that now it is operative. However, a rule 114 AAA, it was made effective from 1/7/23. And failure to intimate Aadhaar number under section 139 AA2 or to linkage, in that case, a higher tax under section 206 AA will follow. And the higher tax, for our easy understanding, we say it is 20%. However, for the purpose of 194O or 194Q, it is only 5%. And similar provision we have for TCS under section 206 CC. Okay. Now coming to thereafter, we have a circular which got this date extended, which was from 1st July 23 to it got extended to 1st March 24, and only in case where PAN become operative as a result of linkage on or before 31st of May 24. In such cases, there shall not be any liability on deductor to deduct collect at a higher rate. That is under section 206 AA or 206 CC. That is for the collection purpose. To understand this, a small case study that Mr. Jetalal, who has paid commission of rupees 10 lakhs to Sundar on 18/7/23, and he has the TDS is also deducted under 194H of rupees 50,000, and the balance amount is paid to Mr. Sundar on the same day, that is on 18/7/23. Mr. Jetalal submitted TDS return on 18/10, that is as per the quarter. But however, on 20/10/23, the TDS statement is processed, raising a demand of 1,20,000 because the pen was not linked. The Sundar's pen was not linked with the Aadhaar, and therefore it deducted 20%. And after reducing that 50,000, the differential amount of 1,50,000 is shown as a demand. On 21/10/23, Mr. Jetalal has deposited additional TDS of 1,50,000 along with interest, and he files the revised TDS statement. And Mr. Jetalal is not, but however, is still not sure of recovering the said amount from Sundar. On 31st of May 24, Mr. Sundar links his Aadhaar with PAN. Now Sundar refuses to pay Mr. Jetalal this 1,50,000, saying my TDS is applicable at 5% and not at 20%, and therefore I will not return you this 1,50,000. Now Mr. Jetalal wants a guidance by his chartered accountant. What are the options available to Mr. Jetalal? Option 1. Either he can tell Sundar, you please claim 2 lakh rupees in your return of income, and whenever you receive this amount of or you get a credit in your statement in your return of income, you can return me this 1,50,000. That is the best option, option 1. Second option would be that Jetalal revises TDS statement. Again, he makes it 1%, and he applies that excess amount of refund, or he adjusts this up to the next subsequent assessment year in the quarters available to him. Because there is a procedure to apply for a refund, that is number 1. However, if he doesn't want to, and if he's sure that there would be the TDS liabilities in the subsequent assessment year, he can adjust this amount of 1,50,000 in the subsequent assessment year also against the other TDS liability which is supposed to pay. That is the best option, I would say, if the Sundar Lal, so if he doesn't want to trust Sundar anymore. The second bullet talks about will benefit of circular available if PAN becomes operative on 1st of June 2024. The answer is clear no, it had to be operative up to 31st of May. Therefore, he will not get this benefit if it is operative after 31st of May. Will benefit of the circular available if TDS is deducted on 1st of April, because here the circular very clearly says that it is up to 31st of March. So if the TDS is deducted thereafter, though it has been linked before 31st of May, however, still he will not get the benefit of this circular. Now, in the above case, if the payment is not for commission, but it is for purchase of an immobile property, the same procedure would be there. However, the procedure for revision of Form 26 QB is much more, I would say, cumbersome. The process is much more cumbersome to the extent that you may have to take an approval of your assessing officer, and thereafter you will be allowed to submit your revised return of income. Well, I think I would like to close my discussion over here. By any chance, if there are not many questions, in that case, I would be allowed to take up, Mr. Rohit, I would be allowed to take up this one case study again on the TDS, which is also an equal complicated. This is trying to interlink between the deduction, the disallowance under section 40A1A and the 43BH, that is on MSME. If a person is on MSME, but I'm not right, I will try to rest my case over here for want of the questions.
Yes, I mean, there are like 5-6 questions. So if you want, you can take this and then you can.
Yeah. If then the time permits, you will be able. Okay.
Okay. So sure, I'll start with the question.
Yeah, please.
Yeah. So in one question is in assessment year 23-24, income shown in ITR, but corresponding TDS missed to claim. So can we claim the TDS in the current year ITR?
Yes, not in the current year ITR. You have, as I mentioned, section 155 subsection 20 allows you to now rectify. So it is, you will have to move a rectification application under 155 subsection 20, and you can take the credit of that.
Okay. Then one question is, I have billed to the government organization on 31/3/23, but the government organization deducts the TDS on May 23. So what's the solution for this? How to claim that?
Come again. You had SSC had been to government
in 22-23, but the TDS were deducted in 23-24.
Yeah, but if it is related, if the income is offered in 22-23, the same way, 155 subsection 20.
Rectification. Okay.
Absolutely.
Okay. Now, whether interest waived on loans on one-time settlement, are they taxable?
That's what I give so much of time for this.
Yes, correct. So
in my view, no, it is should not be taxable. However, the interest portion, however, again coming to, there would be two aspects on this haircut. One would be the principal amount, and the other one would be the interest. The interest would be covered under section 41. So it becomes taxable under 41. However, no TDS is required to be made, and it will not be covered under 28(4) also.
Correct.
Right?
Yes, sir. I think so. The rest questions have been covered. So those are the questions. So we still have time. Like we can.
So fine. Then let me cover up this one last case study, which is on Gada Electronics. Again, this Jethalal Gada. My office is very fond of this serial. So Jethalal, who is liable to get its accounts audited under section 44AB. So as on 31st of March 24, he makes a provision for commission of rupees 5 lakhs payable to Mr. Sundar. And Mr. Sundar is registered himself as a small enterprises under MSN. Gada Electronics has not deducted TDS on commission for assessment year 24-25. commission is not paid to Sundar till completion of audit. During the audit, Babita Iyer and company, who is an auditor of Jethalal Gada, informs Jethalal about non-deduction of TDS as well as non-compliance with provisions of section 43BH. However, Mr. Jethalal does not deduct TDS. So, what is the option available with Babita as an auditor? Babita will report in Form 3CD whether she is supposed to report in clause 21B, which talks about non-deduction of TDS, or she is supposed to report in clause 22, which talks about the amount disallowable under MSME, or whether she is supposed to report under both. The answer would be that there is I would say both the cases, they have not been followed, and therefore for non-deduction, the amount of 1.5 lakhs, that is 1,50,000, being the TDS 30% of the commission amount of 5 lakhs needs to be reported, and the balance amount will be reported in MSME, that is clause 22 of rupees 3.5 lakhs. The question would arise that why do I have to report balance amount under section under 40 for the purpose of 43B? So friends, if you read the provisions of section 43B, it starts as under: notwithstanding anything contained in any other provision of this act, the deduction otherwise allowable under this act. Now, since this 30% of this 5 lakh rupees, that is 1.5 lakh rupees, is not otherwise allowable under this act, so it should not stand to be disallowed. So the balance amount, that is the 70%, 3.5 lakh, which is otherwise allowable under the regular 37 section, and which needs to be disallowed because of section 43B. Now, second is in hands of Mr. Jethalal, disallowance will be how much under section 48(1)A and 43B, or will it be both? So, as per the reporting, the disallowance also will be 1.5 lakh under section 48(1)A and 3.5 lakh for 43BH. And thereafter, in assessment year 24-25, that is a subsequent assessment year, Mr. Jethalal, in computing total income, made 30% disallowance under section 48(1)A and makes 70% disallowance and so on. So sorry, in assessment year he does that as we have decided. He has deducted and deposited TDS in the subsequent assessment year, that is assessment year 25-26, and made payment to Sundar in cash of rupees 25,000, and balance the payment was made by check. Now, what is the effect on the computation for the assessment year 25-26? Here, what triggers in the subsequent assessment year is 3 sections. 1, 43BH, that was disallowed, and therefore 43B, whether as per the provisions, it has to be allowed in the subsequent year. The second is 40A1A, again as per the proviso to section 40A1A, whether that amount of 30% which was disallowed needs to be allowed, and whether the trigger of section 40A3A gets triggered because of the payment above rupees 10,000 is made in cash up to rupees 25,000. That would be we need to answer this question. First of all, let us understand what 40A1A tries to say. If you see, friends, the proviso to 40A1A, it reads like this: provided that where in respect of any such sum tax has been deducted in any subsequent year, or has been deducted during the previous year but paid after the due date specified in subsection 1 to 139, 30% of that will be allowed as a deduction in computing the income of the previous year. So therefore, very clearly, this 30% of the amount, so 1.5 lakh needs to be allowed as per section 40A1A. So 30% will be allowed. Coming to 40A3A, when we read section 40A3A, the wording of the section 40A3A is as like this: where an allowance has been made in the assessment for any year in respect of any liability incurred by the assessee for any expenditure, and subsequently during the previous year, hereinafter referred to as the subsequent year, the assessee makes any payment in respect thereof otherwise. So here it talks about for any year in respect of any liability incurred by the assessee for any expenditure. So where an allowance has been made, here this amount has not been allowed. This amount was fully disallowed in the year assessment year 24-25. Hence, the question of disallowance also under section 40A3A will not be covered. And when I'm coming to section 43B, definitely because of the same provision, the 70% will be allowed, because what has been disallowed in the year one, if he has made the payment to the Sundar, being in a small, being covered in MSME, he will be allowed that 70%. So there is a little loophole as far as the provisions to section 40A1A is concerned, though the cash payment is there, but that would not stand to be disallowed. Friends, with these words, I think I would like to just wind up my talk over here. I understand there were few issues which I wanted to take, but for want of time, I think I will not be able to cover up, because that would take another 4 or 5 minutes, and it's already time for me to give up now. And with these words, once again, I thank the organizers and Mr. Rohit for just extending my time by 2 minutes.
Not a problem, sir.
Yeah.
We
And
loved
once
it,
again,
sir.
thanks Piyush and the entire ICAI team for giving me an opportunity. Thank you so much.
Thank you so much, sir.
I would
As
just
a,
like to acknowledge,
sure.
which I should have done earlier. I have taken few slides from the presentation which was made by me in the residential refresher course of Chamber of Tax Consultant, and those have been reproduced over here. I would like to acknowledge that over here. Thank you once again.
Thank you so much, sir. As we come to the conclusion of this insightful session, I would like to take a moment to express a heartfelt gratitude to you, sir. Mahendraji, your deep expertise and thoughtful analysis of the controversies in TDS and TCS have been incredibly enlightening. Your ability to demystify such complex topics and provide clear and actionable insights had been valuable. We appreciate the time and effort that you have taken to share your knowledge with us today. On behalf of the Direct Tax Committee of ICI and all the participants, thank you once again for your invaluable insights. Thank you, sir.